There are several types of sustainable or socially responsible investing, and these terms can often be confusing. Let's walk through each of the main terms and some real examples of these types of capital allocation decisions. Socially responsible investing, SRI, is when potential investments are screened according to specific ethical guidelines. SRI screens can include issues like gambling, tobacco, weapons, or fossil fuel companies. Some examples of SRI funds include Vanguard FTSE Social Index and SDRP S&P 500 Fossil Fuel Reserve. Impact investing. In impact investing, positive social and environmental outcomes are the key objectives, not necessarily shareholder returns. For example, the TIAA-CREF Social Choice Bond holds a bond that helped a group provide vaccinations to 44 million children. Green bonds. Although closely associated with ESG and ESG-centric companies tend to issue green bonds to support their efforts, a green bond is a fixed income instrument designed to specifically support projects related to climate change and environmental stewardship. A company with a mature ESG presence would be more likely to issue a green bond than a company with an immature or non-existent ESG presence. ESG. Although there is some crossover in these concepts, ESG is ultimately a measure of greater risk and reward management. An example of an ESG fund includes iShares, MSCI KLD 400 Social ETF, a mutual fund that focuses on companies with mature ESG strategies. From a 10,000-foot view, ESG is ultimately important because it has a significant positive impact on fundamental business issues relevant to the long-term success of any company across industries. These business issues include a company's approach to reducing risk, identifying and capitalizing on market opportunities, the quality of their corporate reputation, and aspects of their intrinsic value, like culture, employee engagement, and their overall approach to human capital management. Now let's break down each issue and examine how ESG impacts them. Corporate reputation. The way a corporation manages and communicates about ESG issues signals to investors, customers, and other stakeholders their awareness of the risks and opportunities of changing economic, social, and environmental conditions. ESG can enhance a company's license to operate, making it easier to accomplish their business objectives and respond to crisis scenarios with key stakeholder groups. Referring to the Facebook example from 2018, their billions of market losses were due to their tarnished reputation in managing cybersecurity attacks. Risk reduction. ESG supports identification of both immediate and long-term risks, depending on the industry and business model. Material and labor availability, evolving regulations, and supply chain disruptions are examples of potential ESG-related risks. For example, a food production company in the western U.S. is dependent on a large local labor force to produce and distribute their products. If wildfires, as a result of intensifying climate change impacts, damages the public transportation infrastructure that the labor force depends on to get to work, this is a real risk to the company's business continuity. Opportunity management. Shifting market and non-market conditions, in addition to greater stakeholder engagement and stewardship, can expose unmet needs for new products and services, unserved or underserved customer bases, and vital strategic relationships for addressing ESG issues of mutual interest or concern. For example, Unilever's ESG efforts in emerging markets have resulted in greater profitability and market penetration, as well as positive societal impact. By providing a wide range of training and support to independent stores, kiosks, and micro-businesses in emerging markets, Unilever is accessing new customer bases and generating revenue streams through localized distribution networks that only local vendors could tap into previously. Culture and intrinsic value. A company's ESG maturity is a good indicator of their commitment to building a high-performing, purpose-driven workforce and inclusive culture. Since intrinsic value is a forward-looking measure of company worth based on a company's strategies and its ability to execute them, a more engaged workforce is crucial. In a nutshell, integrating ESG factors into valuation allows for greater insight into intangible factors like culture, talent recruitment and retention, operational excellence, and risk that can improve investment outcomes. For example, a company with an authoritative leadership philosophy and hierarchical culture may dissuade entry-level employees from speaking up if they see and hear something of potential risk or opportunity. A company with an inclusive culture and systems for expressing concern, sharing insights, could avoid a risk or capitalize on a unique opportunity by systematically encouraging open dialogue and communication at every level of the organization. The collective impacts of ESG on these standard business issues leads to outcomes essential to the long-term viability of the firm and the risk and reward ratios of a given fund.